Concept we will be explaining today is depreciation. Depreciation is the systematic allocation of the depreciable amount over a period of time or the estimated useful life of the asset. So what do we mean by systematic and depreciable amount? So systematic means that it is not random. It's based on a system, and the system is applied consistently throughout the useful life of the asset. The depreciable amount is the cost minus the residual value, and the residual value is the asset sale price at the end of its useful life. So what is the business going to sell this asset for when they're done using it? In layman's terms, depreciation is the cost of using the asset, and we need to account for this cost. So you may be asking yourself, which assets are depreciated? Is it inventory? Is it PPE? So you need to know that only PPE assets can be depreciated. Now, which classes of PPE? Because there's three: there's plant, property, and equipment. So only buildings and equipment can be depreciated. Land cannot be depreciated, and that is because land often appreciates, and therefore we cannot systematically account for an expense when in fact the land is appreciating, the value is increasing. So you may be asking yourself, how do we account for depreciation? What methods do we use? So the first method is the straight line method. And that says depreciation is equals to the cost minus the residual value, which you may remember is the depreciable amount, which is why I have it in orange here, over the estimated useful life. Now this is very simple, but they can make it a little bit complicated. So what if the business only purchases the assets in June, when the financial year is from January to December? Well, you need to apportion the expense. You cannot account for the expense for the period or the months that the asset wasn't used. So you will have to say 6 over 12 to account for the months that the asset was used. So if the equipment was bought in June, then you only have to account for the expense from June until December. And you divide that by 12 to show that this is over 12 months. So this is only half of the year. Okay, so the second method that you can use is the diminishing or the reducing balance method. You need to know both terms because in your exam they can specify or require you, the requirements of the question may use either or. So they may say calculate using the diminishing or the reducing balance method. So what are we saying here? We are saying that depreciation is based on the carrying amount and a percentage value. So what is the carrying amount? The carrying amount is your cost minus the accumulated depreciation. You may be asking yourself, so what happened to residual value? Well, the residual value is accounted for in the percentage. So even if the question gives you a residual value, you only have to use the percentage.